My name is Yannick Cudjoe-Virgil. Um, our company is called Merlin Acquisitions. We essentially look for value-add and opportunistic commercial real estate assets throughout Baltimore City, which is where all of our properties are located. I recently went full-time in real estate about 9 months ago. My background is in real estate private equity, worked for a couple of private equity firms as an asset manager. And essentially what I did was that I leveraged that experience to go out and do my own deals and become a full-time investor. So on our website here, we have a bunch of different resources as well, including a multifamily due diligence checklist, which is pretty hot now. A lot of people have been downloading that, just trying to understand different due diligence topics and understanding how to evaluate properties from a due diligence perspective. And then also we have a syndication guide for passive investors as well, just understanding the syndication process. And then also we have our investor group for, folks who are just looking for passive investments. Also, you can go here to our investor portal, which is where our investor communication currently is as well. So I'm excited to talk about how to underwrite larger acquisitions. So given that it's January right now, I'm going to switch my screen here. Given that it's January right now, we are getting a lot of deal flow. I'm underwriting about 500 units right now. And we expected that, right? Because quite frankly, a lot of sellers had to really understand where the market was going in 2022. And I think there are a lot of deals that are coming back to the forefront because, sellers are getting a little realistic. So just want to do a quick mic check right now. Can you guys hear me right now on my mic?
You're good.
Okay, sounds good. All right. So here we have a 220 unit property, right? Well, first, let me say this. As I mentioned when I started talking, was that the difference between the larger and the smaller deals really comes down to the operations piece. And when you really understand the operations piece on a multifamily deal, then everything would come together, right? Because essentially the underwriting is the same from a small property to a large property, except for the expenses really get much trickier and much different, right? On a 10 unit property, you can't afford, someone on payroll, right? But you can on a 200 unit property. And so that's kind of the reason a little bit too why larger assets are more preferable than smaller assets, because you can spend a lot of time on smaller deals because you don't have the resources to be quick on a maintenance call, for example, right? Or from a collections perspective, if a couple of tenants leave on a 10 unit building, let's say 3 tenants leave, you're down to 70%. Whereas if you're doing it in a 100 unit building and 3 tenants leave, that's really not going to impact your cash flow from a net basis, right? So we're going to go through general underwriting on this 220 unit deal here, right? And so when you're underwriting, you really have to have a basic level of how to underwrite. And I think if you do have a basic level, a lot of this, what I'm going to talk about today will make sense. But underwriting just comes with practice, right? Practice, practice, practice. When I first started in this game, what I used to do was all of the properties that were like on LoopNet, I would go on LoopNet and I would download maybe 5 to 10 and just practice the skill of underwriting, because there are different levels to underwriting that you only get through experience, through trainings, and there are a bunch of different trainings out there, but there are different levels to underwriting, right? So I'll give you guys an example of different levels of underwriting really quick here, right? So this deal here, for example, is this is the 220 unit deal right here. This deal right here is a 166 unit property that we're currently underwriting and hoping to get an institutional investor to partner up with. And the difference between this and this model right here, which is a 500 unit property, is, this is more so kind of like a high level institutional base level of underwriting, right? And so I wouldn't recommend someone jump, that's starting off trying to understand like how to underwrite, jump into an institutional model like this, like for example, renewal probability and things of that nature. When you get more and more experienced underwriting, then you start to graduate and get into more high level, fashions of underwriting, which we're going to talk about too as well. So let's go through this 220 unit deal. I'm going to go through basic general underwriting on repairs and reserves, operating funds, things to look at, things to look for, top line revenue, rents, and bottom line expenses, and some acquisition costs as well. That might be a
Can
little
you please
different.
define underwriting for us?
Yep. So underwriting essentially is you are doing a fine tuning on financial analysis, essentially on the property that you're purchasing, right? So basically, what you're doing is you're peeling back the layers on the financials of the property to figure out, does this property make financial sense to move forward with? That's essentially what underwriting means from a general perspective.
And which software are you using to underwrite?
So I have different ones that I've created based off of different the different types of investors. So this one essentially is a Michael Blanc. I'm pretty sure you guys know who Michael Blanc is a Michael Blanc SDA, right? That essentially I just added on different tabs to, right? Some of you guys probably already have this SDA. Michael Blanc, he's one of the, apartment, I guess, gurus out there, for lack of a better word, that, teaches you all the stuff about underwriting. I have other models where, it's a little bit more institutional base or institutional kind of quality underwriting, where there's a preferred return type of structure based off of IRR, more institutional preferred return hurdle type of structure, right? This was more so kind of something that I built specifically for, more institutional capital level underwriting. And then, as I mentioned, with the 508 unit property, this one here is a little bit more, extremely detail oriented, because this model kind of segments renovated units over time, trended rents over time, which is basically increasing the rents by a percentage rate year over year, bifurcating that with unrenovated units, trended year over year, downtime as well on your vacant units, renewal probabilities as well. So this is a little bit more high level that I wouldn't recommend someone who, is just jumping into multifamily kind of learning. I think Michael Blanc's model is probably the more industry standard, basic level underwriting kind of template.
Oh, thank you very much.
Yeah. So,
and do most of the times these models tend to be based in Excel spreadsheets? Thank you.
Yeah. So, let's see here. All right. So this is a 220 unit property, right? Many of you guys probably have already had experience, like, flipping properties and have some sort of knowledge as to, how to estimate repairs and things of that nature, right? All of the things that you probably already know from the single family space, essentially, can be applied in the multifamily space on the interior unit renovations, right? So you have your cabinets per unit, you have your countertops, your appliance packages that you can get from, Home Depot Pro or a Wilmar, or which is now I think Home Depot multifamily, your flooring, your electrical units. One of the things that that is pretty expensive on a larger property is new signage, right? That's going to run you probably around 8 to 10K, maybe on average, depending on what you're getting. For this particular property, I'm underwriting security cameras in a sense, based off of a 500. So this property has 16 buildings essentially. And I'm underwriting that, it's $500 for each building plus a $15,000 install because of the wiring and all of the things that you need to do to actually install the units, install the cameras, rather. The seller replaced the roofs 2 years ago, so you don't necessarily have to worry about that on this one. One of the things that you definitely want to make sure that you're underwriting for, obviously with these larger properties that come with more risk, is just budgeting for replacing HVAC units. Typically, if you know, if there's no matrix that is given to you from the seller's broker on what has been replaced maybe in the last 2 to 3 years, you can certainly kind of fine tune, these numbers. And obviously you would get more information on due diligence as well, but definitely budgeting at least, that you would have to replace at least 50% of those HVAC units or hot water heaters as well. It's something that you really have to factor in when you're taking into consideration, putting together your repairs budget in a sense, right? And all of these stuff, honestly could be priced through, maybe a Home Depot or your HVAC contractor as well, depending on how many, renovations that you're doing. But pretty self-explanatory, right? But you definitely want to make sure that you have that in your line items. Parking lot pave and restripe. This is probably a number that is not going to be easy to get unless you maybe have done it before, or you get in contact with a paving contractor and they kind of give you an estimate ballpark number of what it would cost to pave the site. In this particular property here, one of the units was one of the units is currently being used as a leasing office. So, we would plan to convert that into a rentable unit. And then there's a small area in the exercise room in one of the buildings that we would turn that into an office essentially, right? And we always try to put on a 15% buffer, 10 to 15%, which is another word for contingency on those rehab funds, to make sure that we're protected on the renovations piece, right? So that's kind of essentially, for this particular property, what the repairs would be like, things to think about, things to look for when you're, underwriting some of these deals, especially, on these older properties that might have like boilers and chillers. It's something that can be really, really costly, especially when you're looking at older C-class, 1960s built type of assets. But I think, as you kind of get into the due diligence, you would uncover more and more things that you probably would have to add on to this repairs section.
Is this only
All
for
right.
the inside of the unit? I mean,
I'm sorry, say
what
that
about
again?
is this all the budget for the insides? I mean, what about the external paint and things like that?
Yeah,
Outside.
that's something that you can definitely consider, given that
Okay.
this is kind of like a brick type of building. We didn't think about doing any painting based off of the the facade and how things looked. But that's something certainly that you could think about. Obviously, curb appeal has a lot to do with attracting good tenants to your property as well. So that's a good point that you can add on to some of these, to the larger deals as well.
Thank you.
Okay, so when we're talking about operations too, right? You definitely want to make sure that you have some operating reserves within your properties. Typically, what I like to do is I like to budget at least about 2 months of expenses for operating reserves, which is pretty much means cash in the bank, right? And that's cash in the bank that you might have to dig into if occupancy rates go down during your value add proposition. If whatever happens, God forbid another COVID happens and people aren't paying as much rent as they should be, but you definitely want to make sure that you have enough reserves on your property to weather different types of storms that you might incur. Hopefully not. So we're going to talk about kind of like top line rents, right? From an underwriting perspective, obviously from a gross scheduled income, all that is essentially is what's on your rent roll, right? What is the scheduled amount of income that you're getting from your rent roll? And this is, as I mentioned, it's directly the same as, if you were evaluating a 20 unit property. No difference here, right? Same thing with vacancies, understanding the market, understanding how, your supply and demand factors that would affect the market as well. Same thing for collections and bad debt as well. Things still apply, right? From a 20 unit to a 200 unit property. On the other income side of things, you potentially have more opportunities on a larger property to add things like laundry, right? Where you have another service provider that is responsible for doing all the repairs on the laundry machines, and you guys have a revenue share of maybe like an 80-20 split depending on the occupancy on the property. So the occupancy drops, that revenue share potentially also drops, or you may not get any revenue on the property because obviously the laundry company is in for profit as well, right? So a lot of times, preferably if you can, definitely get a third party contractor to handle the laundry, because that's the last thing that you want to worry about when you're doing a value add acquisition is fixing, broken laundry machines, right? It's just better to have the technology, in place with the new carriers who are doing these, laundry installs, and let them lease, the units on the property, and just implement some sort of revenue share that way that you can get some money back for laundry being used on your property. You have other things like pet fees, you have, other contracts that you could have. So for example, a Verizon contract as well. So if you let Verizon run their wires and things of that nature and do something similar like a revenue share split on the property as well, that's another opportunity to gain some other income on the property, because you have a third party Verizon contract that is placed on the property, and all your tenants are using Verizon, and therefore you have some sort of revenue split because you're allowing Verizon to install their wires and things of that nature on your property. I've seen other operators, and this can vary from market to market, right? I've seen other operators install like carports, for example, and other things that you can do from an other income perspective that would add obviously value back to the net income on your property as well, right? So as I mentioned, the rents from a smaller property, 20 unit to like a 200 unit, in this case we're talking 220 units, there's really not that big of a difference, right, in how you evaluate and underwrite those types of things. A lot of people underwrite, increase in rents over time differently, depending on your level of skill set in the underwriting. So for example, some people just trend the rents year over year, in this case 2% per year, until they get to some stabilized income. Some people break it down from a perspective of, if you acquire the property year one and you say that you're going to stabilize in year 4, then you would do the average income, top line income every year, over 3 years until you get to that year 4 year, if that makes sense, right? So the difference between, in this case, 11,181 versus 11,1253, essentially you would divide that to come to a point whereas the average between year 1 and year 4 is the top line revenue for year 2 and year 3 to get to that year 4. Some people, like for example, we're doing a 166 unit underwrite right now, and you might do it a different way, where you factor in your gross potential in year 1 and you just break it down like a true commercial real estate pro forma, where you have your gross potential rent broken all the way down to your vacancies and your loss to lease based off of the existing rent and your premium rents, and you gross that out to your stabilized number in year 4 as well, where you get your stabilized vacancy and bad debt. So there are like different ways to underwrite. kind of depends on your preference and how sharp you want to get your numbers, but that's essentially what, no change essentially between a 20 and 200 unit in when you're underwriting, these properties. Right. So let's run through some of the expenses that you definitely need to look for and take into consideration when looking at larger assets, right? So I have these bulk set of expenses. Obviously, expenses vary from property to property. Things change from property to property. But these expenses here are, what I would call general expenses that anyone who's doing a multifamily acquisition should be thinking about, should know how to underwrite, especially with a larger property that can afford more and more expenses. So on the advertising side, you might be thinking about having, having your units listed on major paid sites, for example, right? Like apartments.com, right? For 12 months, and also maybe ads that you might run for your apartments as well. And your leasing manager within your property management division would be able to help you understand, like, what is it going to cost for you to advertise these properties, right? So for 220 units, you want to make sure that you're advertising those properties on a monthly basis, because you always want to have those constant leads in the pipeline that your leasing agents could either follow up on, or whatever the case may be, whenever you have those vacant units coming up, right? So that's essentially, from a marketing perspective, kind of like baseline underwriting for advertising. So on a property like this, obviously from a contracting services perspective, there are a lot of things that go in line with how to operate maybe a 220 unit property or a 300 unit property, for example, right? So obviously you have your cleaning expenses that you need to factor in. In this case, maybe $100 per building, 16 buildings, 2 times a month times 12 months, right? Something that you can negotiate with your cleaning contractor. Pretty simple there. You might have landscaping costs as well. And obviously, landscaping costs vary from contractor to contractor, but in this case, maybe $100 for 16 buildings over 8 months, right? Because there's, you typically do landscaping depending on where you live. In this case, I'm in Maryland right now. Typically do landscaping for about 8 months, and then you have maybe 4 months of winter that you might have some snow removal costs that you need to be factoring in and thinking about, right? So in this case, you definitely want to budget your snow removal costs. In this case, budgeted around $25,000 per year for snow removal. And you can get some of these numbers from your property manager as well, which you should always be doing, especially for larger deals, because they have a good pulse on the market for what things cost. And you could also leverage their vendors that might give them good pricing, because they're also using some of those vendors on some of their other properties that they're managing as well. So I always like to use what I call relationship pricing to the best of my ability, because, you always want the good pricing on things, right? So snow removal is something you definitely have to have. And then another thing too is just your annual pest control spray, right? This obviously varies by apartments, how bad the pest control place is. I currently live in an apartment as well, and they have annual, pest control sprays. And so you definitely want to have that from a per unit perspective, because you just never know what someone is bringing into your property. Gas and electric, I typically try to look at the T12 and figure out, what does it look like from a T12 perspective, the past 12 months on the gas and electric. And then I would take the T3, which is the past 3 months, and maybe annualize that to see, okay, in the past 12 months, the expenses maybe were 55,000, but in the past 3 months, it averages out on an annual basis to maybe 50,000. Is this because the seller is paying bills late, or is this because there's just less usage on the property? Those are the things that you definitely want to think about when you're looking at some of these deals. But then also maybe you want to budget in your repairs section to install maybe LED lights, right? To get some lower costs on your, your house meters, for example. So definitely something to think about. Okay, on the admin side, this obviously varies on how you're operating the property. One of the things when I'm looking at underwriting and I see, when people send me underwriting, is that a lot of times they don't budget annual costs for your accountant to distribute those K1s and do those tax returns. For example, if this deal here is, would be a $20 million deal, right? And we would have to raise 4.8 million. If we had, 75 to 100 investors in this deal to get to that 4.8 million, that's 75 to 100 K1s that we would have to distribute. So, a CPA might charge you X amount to do, the returns, but then also to create separate K1s, they might charge you like $75 per investor. You just never know, right? So definitely want to make sure that you're budgeting for that on the front end. It gets much cheaper if you don't have a lot of partners. If I was just one person buying this deal, that number would be down significantly. But certainly think about that, because the more investors that you have in the deal, you have to distribute those K1s. You might have additional maybe accounting expenses as well that sorry, not accounting, supplies. This is misplaced here, not legal and accounting. So supplies, office supplies, and operation costs that you might have to have within your leasing office as well. Those costs definitely you have to factor in. And then the security expense that I mentioned that, we would plan to install maybe $300 per month for the monitoring fee on those security cameras. So those are some of the general things that you might want to think about when you're, looking at larger assets, is some of those costs that I mentioned. I think the next one, insurance, is probably the trickiest without a hard quote, because obviously due to global warming and things of that nature, that's happening across the country. Insurance costs has certainly risen over the past 12 to 24 months, right? So a lot of times, some people might think, hey, I'm going to get the same insurance cost that the last seller had, but that's not the case, because, construction costs have risen significantly over the past 24 months. So though that replacement cost for the building is different, the seller probably, just insured the building to the loan that they had on the current property. So that loan would likely be different than what you're getting on the property as well. So your insurance costs might be higher. Another thing is the seller might have other assets, that's in the area, and they might have a kind of like a portfolio type of policy that would keep this policy down as well. So I think insurance is certainly hard to get and hard to quote. So definitely want to make sure that you have a good insurance person on your team. On the legal side of things, I consider legal to be anything like court costs, eviction costs, etc. I typically do like 1% of net income for the legal costs. It obviously depends on how your property is performing. Are the collections low? Are they high? But then also, the cost to evict as well, right? So blue states are going to probably be a little bit more expensive than like a Texas, for example, right, where it's way easier to get someone out versus a New York, where you probably have to go through a lot of hoops and hurdles to evict someone. Your taxes, this is something that's available either from a website or just calling your local county assessments office to understand, like, are these taxes going to be reassessed at sale? Is it every year? Is it every 3 years? And then it's going to be phased into the new tax rate over 3 years. This is something that is available to you. You can go online, call up to figure out, what are those new taxes going to be when you acquire the property. Trash removal costs, for this particular deal on 16 for 16 buildings, I would probably budget maybe around 300 per building. Typically, if you have like every 12 buildings, you can get like a 5 cubic yard dumpster that can be picked up maybe once a week. I think around $300 per per dumpster is a solid cost for budgeting for trash removal. And then another thing is bulk trash as well too, right? When you're going to some of these properties, when you're walking some of these properties, you can kind of get a feel as to like how the trash operation goes. If it's nice and clean, you're probably not going to get too much bulk trash, but I know you guys have probably went by a lot of maybe Class D properties, and there's just bulk trash everywhere. So you definitely want to make sure that you're budgeting for like bulk trash costs when a tenant maybe moves out and leaves their couch by a dumpster. All that stuff, somebody has to pick that up, right? So definitely want to make sure that you're budgeting separately for bulk trash for someone to be picking that up as well. All right. So on a management fee on a larger property, typically how it goes, break it down between the management and the payroll. So with a larger property, when you get to about, I think 75 units or so, you can afford to have on-site staff. And the benefit to that is now you have a direct person that, so when someone comes to your property, they can engage with that person on site. They can be shown a unit, and they can lease the unit on site. Similar to repairs and maintenance. Instead of outsourcing this to another vendor that's off-site, they can just dispatch the maintenance guy that's on the site, can be fixed, and there's that, right, problem solved. On the management fee side, typically on the larger assets, you might see like a 3 to 4% management fee, which kind of covers like their internal costs, maybe their the accounting on a monthly basis, depending on how you want to put it together for your investors. That's kind of like in-house costs for the property manager. And then budgeting for your payroll. On a deal like this, you might see like a full-time property manager who's kind of like the head manager. You might see an assistant, a property management assistant to that property manager, and 2 full-time maintenance guys, right? So here I have it, maybe 65,000 for a head manager, 50,000 for assistant, and then 45,000 maybe for 2 on-site maintenance guys, right? You could probably, may want to add another maintenance person depending on, how you plan to operate. But I think that's a good plan to attack for maybe 200 units, right? One of the things that you want to make sure that you're budgeting for as well is your payroll and benefits taxes, right? For like FICA taxes, which is, I believe, 15.3%. Typically, if you're a W-2 person, you pay half and your employer pays half, right? And so if you're hiring somebody full-time on your staff, you're going to have to pay that payroll taxes, and you're likely going to want to offer them benefits as well, because they're going to be essentially working for you, right? Or working for the property manager or the property. So definitely want to make sure that you have that budgeted for. One of the things that I wanted to bring up as well is when you're managing some of these properties and your property manager is hiring, depending on who's doing it, I like to make sure that my maintenance guys have at least one trade. And the reason is because if my maintenance guy has a plumbing trade, an electrical trade, or an HVAC trade, I don't need to dispatch someone for HVAC if I already have someone that I'm paying on payroll that has HVAC experience. So if an HVAC goes out, I don't have to call 123 HVAC company to come out and fix this. I already have somebody on site. That saves so much money when you have your maintenance guys have a trade on your property. It saves so much money, because how many times as investors we pay for like plumbing, electrical stuff, maybe HVAC stuff that goes out because a tenant doesn't want to change a filter. Those are the little things I think that you really have to know and understand to operate your property successfully. All right, so maintenance, repairs and maintenance, this is kind of like a T12 and a T3 estimate type of thing. You look at the seller's financials, figure out, does this make sense? Talk to your property manager about it. Maybe look at the T12 to see if it's, how it was in the past 12 months. Look at the T3, size that over 12 months, try to get the average, you try to make sense of it. I think repairs and maintenance is just, depends on how your property is currently operating. And I just have this one thing here, telephone service, small budget for telephone when someone calls the leasing office, and your Wi-Fi bill as well, $100 a month, right? Not too expensive. And then the water and sewer, same thing, right? Similar to like, repairs and maintenance and gas and electric. You look at your T3, you look at your T12, size it, see if it makes sense, see if you can save maybe by adding some low flow toilets and shower heads within your repairs and reserve budget to kind of cut that water cost down. Or maybe if you're billing some of the costs back, maybe 15 to 20 bucks back to the tenants if the market allows it, to kind of cut down on some of that overall water cost, or get reimbursed. I think it's a good way to approach when you're looking at any property, quite frankly. And then you have your deposit for replacement reserves that your lender might require, or you should have, definitely, because things break over time, right? So all right, so that's that for expenses. I'm going to go into acquisition costs really quickly. This is kind of like high level acquisition costs, not too detailed, but obviously you got your PPM costs when you're syndicating, depending on the size of the transaction. We have a really good attorney, SEC attorney. I'm going to think about her name in a sec. But they essentially have really good costs on their legal fees and putting together these syndication documents as well. You might want to budget maybe 15,000 or so for these types of deals. Your property inspection, maybe 150 per unit for the property inspection. And then your lender fees, maybe if you're doing like a Fannie Mae, a Freddie Mac type of deal or something like that, you typically put down a loan application fee, maybe of like 20,000 to 25,000, I think, in this range for this type of property. That typically covers your environmental, your PCA, and appraisal. That's something that you have to pay up front. That is, quite frankly, non-refundable. And depending on who you're going with, maybe a loan origination fee of half a percent or 1%. Then you have your loan commitment fees on the back end, which is kind of like on top of your good faith deposit as well too. And then you have your closing costs that obviously, it varies by title company and where you live. And then also your escrowed costs that your lender might ask you to escrow, which is, maybe half of a year's worth of real estate taxes and insurance. Kind of depends on the lender. So essentially that's kind of like, what you should be thinking about, obviously, I think, for any deal when you're doing multifamily, on how to pencil out some of these acquisition costs. So I hope I did a good job talking about underwriting and underwriting large multifamily deals. I think, as I mentioned, the difference between the smaller stuff and the larger stuff, for the most part, lies in the operations and understanding like how you're going to operate the property and what your income sources might be as well. Because you have a larger property, you have more bandwidth and flexibility to add on different things to make it more profitable for you and your investors. So that is essentially it for underwriting larger multifamily deals. I'm happy to talk more, answer any questions, talk about multifamily, whatever you guys want to talk about.
I got a quick question.
Yep.
When you do your underwriting, are you also doing underwriting to determine red light, green light, yes, no on the deal, whether it's a good deal? Or through underwriting, once you get a lot of experience, you know how to do things, you can make what's a questionable deal a good deal. Which way do you underwrite?
Yeah, definitely. I think when I underwrite deals, I try to do the least amount of work as possible, unless I know I really want the deal, in a sense, right? Because doing something like this could take hours and hours and hours. And we always have like version 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. So it's like you definitely want to do a sniff test to even see if the deal makes sense, simply from a income and expense perspective, right? Before I even go into like repairs and reserves and acquisition costs and things of that nature, and kind of really fine tuning that underwriting. I just want to make sure from an income and expense perspective and the price that they're asking, if this deal even makes sense. Obviously based on the debt as well, right? Because we've had a lot of deals last year where we passed on because it just didn't make sense at the current debt prices. And I think when you're looking at any deal, I think that's the best way to kind of do a sniff test to figure out, do you really want to spend 5 to 10 hours, underwriting a deal that isn't going to pencil out? So I think focusing on your income and expenses going in and just, penciling that down to the price is a good way to kind of start off to see if it kind of just makes sense.
How much of the information do the sellers provide about the deal and about their property, so that you can even have some kind of a sniff test in place?
Yeah, so it depends. If it's off market, direct to seller, sometimes they don't provide as much information. Like a lot of times the brokers are the ones who are advising their clients on like what they need so they can market the property better. So a lot of times with the brokers, you get way more information and detailed information to make the best decision for the investment or your investors. And then the off market ones, they typically don't have a list of items that we would want to see, right? Like your a T12, maybe a capex sheet of like all the capex improvements that you made in the past 12 to 24 months. Your loss runs, for example, right, which you're going to give to your insurance provider to make sure that you are that if the current seller made any claims on the property, right? Because that's going to have an impact on your policy as well if there are previous claims, which is also something that you should be taking a look at too, to make sure that you know why there was a claim and what it was about. So it generally depends on like who's selling the deal. If it's off market, you're probably going to have to like push and pull for the data. But if it's through a broker, they know what multifamily buyers look for and what they need. So
Thank you.
any other questions?
So Yannick, I mean, how do we develop this skill? Is it just by playing around with that spreadsheet from Michael Blanc and then getting expertise and then using our prior experience and trying to work out that spreadsheet?
Yeah. Honestly, it's just repetition is the mother of all learning. I think it's something that just gets developed over time as you look at more and more deals. And a lot of times you have different deals that you can revert back to on the costs in a specific area, or the cost, your property manager probably gave you a quote on with the last deal that maybe didn't work, or maybe a current deal that, that you're working on as well. So as I mentioned, I think the best way to get more experiences, everything on LoopNet right now, I would just download the OM, reach out to the broker, get the T12, get the rent roll, and just underwrite the property like you were buying it, right? And maybe, ask someone, hey, does this make sense? Does this property make sense? Does this underwriting make sense? And then just do the next one and the next one and the next one. I think over time, you're going to develop the skill set of like penciling out these deals to where you feel comfortable moving forward. So I think that's a good skill set, for an active and passive investor, quite frankly.
Thank you, Yannick.
Thanks for sharing.
Absolutely. Any other last questions?
One last question, Yannick. This is Lawrence.
Hey, Lawrence.
So you said that the sniff test, is there a specific formula that you use to calculate that out?
So not a specific formula. I guess what I'm talking about is, if you, so for example, if you're using Michael Blank's syndicated deal analyzer,
Mhm.
just simply using this scenarios tab that he has right here, I think is a good way to get a sniff test on it. Because you don't want to spend too much time underwriting a deal that's just not going to work. And a lot of times these numbers would just tell you if it's going to be too tight, or if it's, or if the deal potentially would work, right? And I think from there, it's like you kind of you expand maybe into your repairs and reserves budget and your rents and back into the pro forma. I think, using the scenarios tab and just underwriting the deal from an income and expense perspective, going in, at acquisition versus maybe what the rents would be like at stabilization, is a great way to kind of develop like a sniff test to determine if you should spend another 3 to 4 hours looking at a deal. Because it's easy to get down a rabbit hole on some of these deals, but if it doesn't make sense from a sniff test perspective, it's probably not going to make sense for you to spend a lot of time on the deal.
Gotcha. Thank you. Very much appreciated.
Great. Any last questions before we sign off for the night?
Appreciate your help and thank you for your kindness.
Thank you
Thank
for
you.
your
Absolutely.
Yeah,
time,
that's really
sir.
helpful.
Thank you as always.
Thank you.
Absolutely. All right, guys. Well, I appreciate you guys taking the time. Hopefully this was helpful. I see Donald, did you have a question?
Yeah, the only question I had was on insurance. That I missed that part. So how do you come up
Yeah.
with the insurance?
So what I
assumption?
was saying with insurance was that
Mhm.
it's probably one of it's probably one of the trickiest of your expenses, because you just never know, what your seller claimed on the property in the past. The cost to build is increasing, has increased since the pandemic. And the seller's policy might have been policies that they combined with other properties under a master policy that maybe lowered this policy on this property, and other factors that that, and also the loan on their current property, they might be insuring the property for the lender's loan amount, and that loan amount is lower than your loan amount as well. So that's why I say like insurance is probably the trickiest one to get, because there are a bunch of different factors that come together when getting a hard quote for an insurance policy. So it's like you really have to have a good insurance broker that you can just like send to, and they should be able to tell you like what the ballpark would be going in.
Got it. Yeah, that's helpful.
Sounds good. All right, guys, I appreciate the time. We'll be here again next Thursday. We'll let you know the topic for next Thursday. And thanks again for joining the webinar this evening. So have a good night.